Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show, we'll be joined by our guest co-host, Patrick Horn. He's portfolio manager at Aglyth Capital. And later, our featured guest is interim parliamentary budget officer Jason Jacques. He will break down the PBO housing report for us. And of course, we want to hear from you on First Call. Call us with your questions on Canadian stocks, and we'll have Patrick answer as many of them as he can. The number to call will be 1-855-326-6266. We will open the phone lines in about 30 minutes. And of course, our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Royal Bank of Canada topped income and revenue estimates in its latest quarter. Canada's biggest lender delivered strong results in its capital markets, wealth management divisions, and personal and commercial banking. The U.S. capital markets franchise accounts for more than half of the unit's revenues. The firm also boosted its quarterly dividend by 6%. And National Bank beat analyst estimates on net income and revenue in its fourth quarter. The Montreal-based lender also posted better than expected results at its capital markets unit. This is a resurgence for the division after it missed forecasts in the previous quarter. The firm is set to take over Laurentian Bank's retail and small businesses in a three-way transaction that includes Fairstone Bank. TELUS will pause its dividend growth while continuing to pay its quarterly dividend at the most recent level. The pause will remain until the telecommunication company's share price reflects growth prospects. The Vancouver-based company also announced a new three-year free cash flow growth target of 10% compounded annual growth rate. And now, of course, our top line story this week, it's all about the banks here in Canada. And like we mentioned, two more names have joined the party, and I think they're having a good time, RBC and National Bank. To break it all down, let's bring in our guest co-host, Patrick Horn of Aglyth Capital. Patrick, thank you very much for joining us today.
Thanks for having me on.
We saw the numbers. Well, let's start with RBC. Your thoughts on what we were looking at?
Strong numbers, especially from the cyclical components. So capital markets were strong. The banking, retail banking is a mainstay, and loan loss provisions are in check. I would expect these trends to stay in place for a while. These are very good numbers. I think the dividend increase was a surprise for me, at least. And it's always nice to see. Dividends are often, especially for banks, it's management's way of basically forecasting continued prosperity and continued growth, usually a little bit above where the street is. So I think Royal was very strong, and National was. Not to be outshone by Royal, but they came in respectable numbers as well.
And with RBC, the cyclical, any concerns there? We talked about it off there. Go into a little bit more about. You don't think there are as many concerns about it?
Not at all. No. Our expectations is that what we see in this economy is going to continue. We're kind of in locked horns right now between monetary and fiscal expansion, and we have in certain industry groups that are doing really well, and industry groups that are not, and a few parts of the population are doing well, and many that are not, and that's the juggernaut right now. So, the monetary authorities are leaning towards the people who are not doing well. Sympathize. You focus on labor and employment, and the governments have no fiscal discipline, and that's a habit over the past 15 years that they've learned, and now we have a very big budget flush or a cash flush from formerly cash hoarders, the scalers, hyperscalers, and their spending. So we're looking at this going, okay, this is just going to continue. This has got legs for 2 or 3 years, where we have above average inflation. We have no one stopping this train, and we've got loggerheads on the fiscal and monetary supply.
And just one thing I noticed, provision for credit losses went up.
Yeah,
was higher.
sorry to get back to the banks. I shifted
I know you
to
went up. We'll bring it
macros.
back. But for IBC, they were up slightly. They were
Yeah.
up. It was their number was up higher than analyst estimates.
Yeah.
Any worries on that, or just a little foreshadowing?
No. I don't think at this point in the cycle, we think there could be a low hum up in some of these, but I don't think it's all that serious. I mean, for the most part, credit is very manageable. We kind of went through a couple series of downgrades in credit, and I'm sure the credit departments have all looked through their books. They kind of washed themselves out in 2022. Then we had a couple of mini bursts, and certainly the Trump tariffs was a complete review. So they've sharpened their pens and they're looking at things pretty closely. I don't anticipate this being an issue at all.
Okay, and then National, of course, the acquisition of Canadian Western and now Laurentian. Yeah. Is there room for organic growth?
Yeah, well, National's proving themselves to be a national player. And I would think so. I mean, they've got a strong capital markets. They have, Quebec fortress in terms of their fees. They've proven themselves to be very good niche operators outside of Quebec as well. So I wouldn't discount them.
And then, what we're seeing today, will that be enough to satisfy investors?
Oh, I think so. I think this is these are not demanding multiples for these stocks. They carry very handsome dividends and a dividend raise from Royal. They're growing well, and I think Royal just raised their guidance as well. I think they pushed their return on equity up to 18%, which is going to, I think, surprise the street, or at least encourage the street, bring their numbers up a bit. So the cheap stocks that outperform, that's the magic of my business.
All right, well, we'll leave it at that note there, but lots more to talk about. Up next, we'll take a look at the markets ahead of the open, and Patrick will tell us why the stock market is booming while the consumer seems to be a little more miserable. See how things are shaping up on the markets. We'll start with the U.S. futures, and there's growing optimism over a rate cut by the Fed, and that's fueling the markets today. You can see Dow up by a quarter, NASDAQ about the same. Actually, they're all in the 0.2 to 0.3 range right now as we head into the day. And the major Asian markets, let's see how they finish the day. It's a mix. The potential Fed cut and strength in technology shares helping Japan. The Nikkei up by 1.14%, but down days for the Hang Seng and the CSI 300. Heading to Europe, again, it's the rate cut. Everything's about the rate cut and a rebounded tech stocks there. The FTSE off by a little bit, but the CAC 40 and the German DAX up by 0.26%. And the TSX yesterday, well, it was off again. A strong day by the banks wasn't enough to offset losses in materials and energy, finishing the day down slightly, 0.17%. Let's see some of the movers. Biggest winners, Laurentian Bank, no surprise there, up 18.4%. Energy Fuels up nearly 7%. Curaleaf off again, down by 4.4%. And Go Easy down by 5.9%. And taking a look at the metals. Normally we talk about gold and silver. I got a bit of frog in my throat right now. And they're up, but copper's the one to look at right now. It's up 2.37%. And that is in record territory. A surge in orders for metal in the London Metal Exchange warehouses is what is pushing this copper up right now. And taking a look at the oil sector, and you can see Western Canadian Select down again, almost at 45, off by almost 2%. And WTI, where is it standing right now? It had a bit of an up day as it starts pushing back up towards $60. Well, the stock market's soaring, but most consumers are feeling the pressure. We're back now with Patrick Horn of Agilith Capital, and he's going to tell us what's behind the K-shaped economy and what it means for investors. And Patrick, it's getting to be a big K, isn't it?
It is, yeah.
And that's always worrisome.
Yeah, we're seeing the K play out both on the consumer side and the supplier side, and So, and as I touched upon, it's causing basically gridlock among the major policy responses to this. On the consumer side, the easiest way to think of it is you've got 10% of the population that are asset heavy, whether they're in stocks or real estate or whatever, and they're doing well. They're doing
Life is good.
very, very well. They're spending. They're actually supporting many parts of the economy naturally from their spending. And then the rest of the 90% are looking at their budgets and seeing their budgets shrink because you've got pain points of inflation here and there, and they're having to make tough choices. And there is a constant reminder of these choices, and you can see it from the consumer surveys. It's terrible. This is like one of the worst periods that I've experienced as a professional. And you sort of look around and you go, okay, is it really that bad?
But it's easy to be trapped in the bubble if you're not one of the 90%.
Absolutely, it is. So they make tough decisions every day. They feel like they're falling further behind. Similarly, we have had, formerly on the supply side, on the private enterprise side, you've got companies that have basically decimated other industries. So the hyperscalers getting into everyone's business, basically bringing some commoditization of technology forward, and now they have been cash hoarders. They've just had tons and tons of cash that they basically keep outside of the U.S. economy and the Canadian economy, and they buy back their shares. They do dividends. And it's just been kind of. Now they've got an excuse to spend, and they're spending like they've done a complete 180.
Like a drunken sailor?
Like a drunken sailor. And they're all in an arms race right now to find the best AI tool that they can come up with, because they know that AI ultimately is going to take down the barriers to entry of their business model. And if one finds it first, they're at risk. So they have no choice but to spend, and spend hard. And so we're seeing massive amounts of capital deployed, like we have not seen. This is like the only time I can really compare this in my professional career is as the .com bubble, and where everybody, there was only one topic that anyone wanted. What's your .com strategy? Yeah. Right. Where's your servers? How are you going to get, and so everybody wants, the next 5 years tomorrow. And certainly that's the behavior here. So, there's the knock-on effects are massive. So we're getting into when they spend money, it's got to be in the physical world. Yeah. So power, equipment, buildings. So, just to provide power for these data centers, just in the U.S., not around the world, just in the U.S., it's going to take 3 New York cities of power equivalent over the next 5 years. It's massive amounts, and it's going to put more pain pressure on, electricity prices and everything. So,
can that all be balanced?
No, it's not. It's not. It's going to be sloppy because they don't care. Sorry, they care about one thing: finishing the race first. Yeah. Because that's how their mindset is. That's how they're trained to think.
And should we be worried? Because there was an email that apparently is floating around from Sam Altman from OpenAI, declaring a code red that has to improve the quality of the flagship product. I mean, is that him running scared, or?
I think. Look at it.
Should we be worried about where this is going? The AI.
I think that technology lives in a world of winner take all. Okay, you don't see a distribution of 5 or 6 companies that share the pot. You see a dominant company, you see a weaker one beside it, and then you see a decimation of companies behind it. And that tends to be the behavior.
And you feel that's where we're heading.
That's where we're headed, and they know that's where we're headed. And so it's kind of all guns forward, like as fast as we can. And I think I think Google surprised us with just how good Gemini 3 was, but this is not the end. I mean, these are going to be iterative forces and reaction. So, my big thought here is if you look at the correlation between industry and CapEx spend, when you spend a lot on CapEx and you increase the supply of your tools to the public, that's usually a very negative sign.
Oh.
So think of all the bubbles that we've been, housing bubble, .com, energy bubble, all of these things. It's when we push forward really, really hard, and we because we just can't absorb this. So what we're probably going to see are these fantastic AI tools given to the public practically for free. So there is going to be a transfer of wealth from these hyperscalers to the rest of the economy.
Okay.
And so our belief is that's where you want to be in the rest of the economy. You're going to want to see who's doing what, how this is being implemented. I think every new grad today is going to have AI in their pocket, and they're going to say, I can do this,
Yep.
and this, and I can do way more than what my predecessors could do 10 years ago.
All right, we got to wrap.
Yeah.
We got to wrap it up there,
Yeah.
Patrick. But it was an interesting conversation. There's so much more we could talk about on that. Patrick's going to be back though with why precision drilling is on his radar. That's just ahead. Time to see what's on the radar for Patrick Horn of Agilith Capital. And one of them is energy equipment suppliers. A few of them actually are on his radar right now. And we'll start off first, Patrick, with precision drilling.
Yeah,
it's going back to, I think, our conversation, right?
That's right. That's
picks
right.
in the ground.
That's picks in the ground. So, once upon a time, the oil was incredibly cyclical. You could have doubles and triples of the actual price and paid at the pump. And we went through the 70s, went through the 80s, went through the boom and the bust cycles. I think what we're seeing right now is oil behave more like an industrial, where they have a small cyclical component, but because the world is just adopting to more oil, more usage, and we're getting used to low oil prices, and we don't have the supply disruptions anymore. So if you look at the Canadian oil patch, they behave more like a factory than they do like your typical mining company. They've eliminated their costs are so low. Their embedded historical costs are there. Mm-hmm. Their variable costs are low, which means they can ride out fluctuations of $10, $20, even $30 in the price of oil. So we look at it and go, okay, there's a change in behavior of the actual producers, and therefore what used to be even more risky than the producers, which were the suppliers of the tools, Precision, Trican, Enerflex, that's where the opportunity is, because they used to have a lot of volatility earnings. We don't think the volatility is there anymore. We think that's a massive opportunity. So they're very cheap on a free cash flow basis. They trade in the teens. So on an EBITDA or earnings basis, somewhere around 7 or 8. Mm-hmm. EBITDA somewhere around 4. 4 if they didn't put any capex back in their business, you get paid back in 4 years, 5 years kind of thing. So these are wonderful businesses. We think they're mispriced, and we think there's lots of opportunity. Now, getting back to the AI story,
we want to get your other two stocks in too.
Yeah.
Sorry,
go ahead.
Finish the AI quick.
Yeah. So the energy needs for all of these these data centers that are put up, they're make no mistake, they have to use. They're probably going to use natural gas. They're going to have to use fossil fuel to run it for the first 5 years. Everything else, nuclear, which is probably their optimal from a public policy, is
still down the road.
Takes so much time to do. So, okay. And these guys have such a push. My understanding right now that generators are they're 2 years out right now from being delivered. That's how tight it is right now. and they're going to snap everything else up. These guys are in such a race to buy this stuff and to make sure they have it, and more importantly, make sure their competitors who are also building it don't have it. So this is your classic logjam.
Okay, we got to wrap it up there, but we're going to be back. And still ahead, new forecasts show that Canada is expected to build only 26,000 homes over the next 5 years. And of course, our phone lines will be open soon. For first call, 1-855-326-6266. You can send us an email, first call at bellmedia.ca. Royal Bank of Canada topped income and revenue estimates in its latest quarter. Canada's biggest lender delivered strong results in its capital markets, wealth management divisions, and personal and commercial banking. U.S. capital markets franchise accounts for more than half of the unit's revenues. The firm also boosted its quarterly dividend by 6%. Enbridge has increased its dividend by 3% and reaffirmed its growth outlook in its 2026 financial guidance. The Calgary-based pipeline operator has $8 billion worth of projects entering service in 2026. It also expects strong growth from recent rate settlements and rate cases in gas distribution and gas transmission. That happened last month. The energy company approved also a $1.4 billion U.S. expansion to boost deliveries of heavy oil. Toronto home prices continued their declines in November, caused by slowing demand. According to data from the Toronto Regional Real Estate Board, sales in Canada's largest city were down nearly 16% from the same time last year. The benchmark home price was also 5.8% lower. Stagnation comes as tariffs imposed by the U.S. are deterring consumers from making some big purchases like a home. And taking a look at the markets, looks like the rally will continue south of the border. Futures right now, all of them in the green at about 0.2% mark. Well, federal spending on housing is expected to decline by more than half over the next 3 years if current programs are not renewed. This, according to the Parliamentary Budget Office. Now, within its current spending plan, the PBO says Build Canada Homes will add only 26,000 homes in the next 5 years. In August, the PBO said Canada would need to build about 700,000 homes by 2035 to restore housing affordability. Joining us now is Jason Jacques, the interim parliamentary budget officer at the Office of the Parliamentary Budget Officer. Thank you, Jason, for joining us today. That is a mouthful. And that's some concerning numbers. Will we see these programs eventually renewed, and will they be renewed at the same level?
That's a good question. So, on our end, we're working with the public data published by the government as part of their short-term planning, their longer-term planning, and of course, we're looking as well at information that was shared with us by the Department of Finance around Budget 2025, which shows about a 56% decline in federal spending on housing. There might be subsequent decisions made over the next 3 years. But I think as most people realize, if the public numbers are forecasting some sort of decline, there could be an offset, but you got to go with what you see right now.
So I'm curious, how do you circle the square here between what seems to be an oversupply based on pricing that was, most likely outdated, and a shortage of new homes that really, where I guess the public at large really needs more affordability. How do you bring those two forces together from here? Because it seems like we do have a bit of a mismatch. In terms of
oh, sorry. Go ahead.
No, just
no, I was going to say
yep.
It's a really good question, and I think there are two things going on. And the first one, I think you hit the nail on the head in terms of the homes that, for people who are actually looking to get into their first home, the homes that they're looking to buy, the supply of those homes on the market. There isn't necessarily the supply of those homes in the market. So within various markets across the country, the people that are looking to move from renting into buying their first home, or just looking for a rental to rent something, there isn't the supply there that they would necessarily need and look for. The other thing to keep in mind is there are like effectively 16 distinct regions or housing regions across the country. So while Toronto obviously has a really big weight alongside Vancouver and the other major metropolitan areas, there are 16 distinct regions. So even if there is an oversupply in the case of Toronto, not everybody's going to move to Toronto, and obviously you can't take the housing supply from Toronto and shift it out to Montreal.
So, do you think at the end of the day, the federal government's going to make money on this program? Is this is the goal here to stay neutral, or is this basically like a subsidy just to help the average Canadian out?
I think in terms of most government programmings, obviously it's the public sector. So the government is not getting into it to make money. That's why we have the private sector, and that's why we have capitalism. That said, there is a good part, especially on the Build Canada Homes side, a big part of the funding, which is offering loan guarantees and concessionary loans, which could provide some sort of revenue back to the federal government, potentially to sustain the program and sustain the organization. But obviously, with most government programs, one would expect that there's going to need to be some sort of ongoing federal support to keep these programs in place.
And now you mentioned about getting the private sector involved. It's with everything that's unfolding within the housing market right now, there doesn't seem to be an appetite. How do you convince them that to get involved and it's worth it to them?
Well, obviously, we're not experts in that specific area. We did look in detail at what the government's doing around Build Canada Homes, and I think looking at the structure of the new organization, it is pretty instructive, because it isn't simply a question of the federal government cutting a check to somebody and kind of hoping for the best. It is more of a comprehensive approach where you do have a suite of financial supports that are offered to private sector developers. In addition to that, focusing on the federal assets themselves and looking at opportunities for conversion. And last but not least, something that Build Canada Homes itself isn't looking at, but the government has indicated within the housing sector it's looking at, is on the regulatory side. So both if things can be simplified at the federal level, and in addition to that, especially as part of the Housing Accelerator program, leaning on municipalities across the country to try to streamline regulation to make sure that, the regulatory burden on developers or on the private sector when they want to go in and build something, it's a lot lower. So that both saves time, which is money, it also saves money, and it also provides certainty, right? So if you're looking at a 24, 48-month cycle where you need to go obtain the financing, get the land in place, line up the potential buyers, and start to make those investments, there's additional certainty in place. So the math in the spreadsheets works out.
So if you're at the helm and you're able to influence 100% of policy here, what would your projection be in 5 years? Where would we be at with this program in terms of new housing?
So on our end, within the Parliamentary Budget Office, we don't do policy. We only do numbers.
Sure.
So effectively, we're the referee. So we're the folks that are supposed to look at the numbers and look at the spreadsheets presented by the government around their policy plans and say, okay, in reality, this is what cold, impartial analysis would tell you, as opposed to the thousands of comms people who work in government are going to tell you with the glossy brochures and the nice websites. The numbers that we're looking at this point, based upon the historical track record of the government, indicate that there's probably going to be about 26,000 units created over the next 5 years in Build Canada Homes. The government has a higher number, and I think from the government side, their argument is what they're trying to do with Build Canada Homes is, I think they've used the word transformative. Certainly, from our perspective, it very well might be transformative. What we look at is what's the government's track record. Similar to, I guess, what your audience is familiar with. If there's a company, publicly traded company that's out there, they have a track record, you know what the return on equity is, you know how effectively they can execute on plans. If that company comes out with a press release and says, you know what, don't pay attention to what we've done in the past, focus on the transformative element of what we're doing in the future, for which we don't necessarily have a track record, potentially it's something you might want to pay attention to. Potentially the numbers might be a lot higher than the 26,000 we've come up with at this point. And at the same time, there's the weight of history that the government obviously has to deal with. And again, 26,000, it's not nothing. So we've, as you mentioned at the outset, we've indicated the government, there's a gap of about 65,000 homes and builds that need to happen every single year for the next 10 years to restore affordability. So if we're looking at an additional 5,000 a year over the next 5 years, it's definitely a step in the right direction.
Okay, we have to end it there. But Jason, thank you very much for joining us today.
Thanks for your interest.
Jason Jacques is Interim Parliamentary Budget Officer at the Office of the Parliamentary Budget Officer. Coming up, another small Canadian bank is off the market. Laurentian sells itself in 2 chunks to Fairstone and National. We'll hear from Laurentian's CEO after this. And of course, our phone lines are open. Patrick is taking your questions on Canadian stocks. Call us at 1-855-326-6266. You can also email us firstcall@bellmedia.ca. Laurentian Bank is selling itself in 2 parts. Fairstone Bank's getting some. National Bank is getting some. We sat down with Eric Provo, President and CEO of Laurentian Bank, for more on it.
We were looking for partnerships and ways to actually be able to move away from the big banks model and focus on our strengths, which we strongly believe is commercial banking, and we've been quite good at this over the years. So it landed this way because we developed quite a good rapport with Fairstone Bank, and the outcome for our retail customers lending to National Bank is actually great, because another very solid Quebec-based bank, and that will offer actually our customers a broader scope of product, and more importantly, much better technology in terms of banking tools.
So the Laurentian brand itself will be kept, is that correct?
Yes, and that's another great news for us today, is that we will operate under the umbrella of Fairstone Bank as a subsidiary. I get the privilege to continue and lead that great team based here out of Montreal, and we'll continue. Like, this opportunity for us is amazing, because we'll be able to continue and grow in segments where we exceed, and I believe this will create even more opportunity for us in the future.
That being said, your branches in Quebec under the Laurentian Bank name will close. How many employees will lose their jobs?
Yeah, that's the sad part, and there's always a component in those strategic decisions that makes it so difficult. But at the end of this process, and again, like, not as of in the upcoming period, like this needs to get approval by our shareholders and the regulatory. But at the end of the transition process towards National Bank, we'll be closing our branches here in Quebec, and about 700 people will be impacted by this decision of restructuring our retail activities.
Yeah, so quite a few. Okay, there were challenges of being a smaller bank operating in Canada. Can you explain 1 or 2 of the bigger challenges you faced?
Well, actually, I think it's related also to our positioning, being a very focused regional bank here, as well as the lag and gaps we add in terms of technology, and really the fact that we weren't able to attract new customers, and the investment required to equip ourselves with the right tools on a digital front, and that did not justify the investment and the return. So like I said from the get-go, at our strategic plan, we really wanted to focus more on our strength, and this transactions allow us to actually accelerate this plan.
You were looking for buyers about 2 years ago. Were either of these companies, either Fairstone or National, interested at the time?
I won't really come back on the process. Like, we all know, it didn't land anywhere, and we got to to where we are today. I'm very, very happy with this conclusion because, as I said, and I'm reinforcing, like, if we were to be acquired by a large bank, I believe it would have been the end of a great institution, 180 years close to existence here in Quebec. And I think Fairstone recognized the brand, recognized the value there. And for us, it's a new chapter. We're turning a page today, but definitely opens up for a great future for this organization.
You need the 2/3 support of shareholders. What have you learned from shareholders so far about this deal? Whose support do you already have?
Yeah, well, our biggest shareholder, Caisse de dépôt, CDPQ here in Quebec, that has been a long-time shareholder and big support of us, has agreed for voting support in favor of this transaction, which is major for us and send the right signal that this is a good transaction for our shareholders.
Have you heard from other shareholders?
Well, no, not directly, but the most important one is definitely CDPQ for us.
So what does this mean for bank clients, individuals and commercial clients? If you could just explain the way forward for them.
Yeah, so for our clients, the message is you have nothing to do. Like, we are going to take care of the transition, the migration, working with National Bank to make sure that it's an easy and simple process. So no actions. And by the way, all our operations are continuing as they were before. Like, our people are in the branches. We now have a page on our website that is dedicated to Q&A, as well as a dedicated phone number for customers to reach if they have questions. And please, I'd like to remember all of our customers listening, we will not reach out by text or by email and asking you to click on anything. Like, this is not the way we're going to communicate with you. And please beware, like, be careful, because some out there will try to benefit from an announcement like this. And this is not the way we operate. So please, wait for us to reach out in a way that is either paper or through our application or website, and nothing to do right now. Like, we'll keep you posted and informed while we progress towards a transition.
Morella was speaking with Eric Provost, President and CEO of Laurentian Bank. Still ahead, we'll take a look at some notable analyst calls and recommendations, including one on Ralph Lauren. All right, let's take a look at some of the notable analyst calls and recommendations. Bernstein has raised the price target on CrowdStrike to $353 US from $343 and keeps a market perform rating on the shares. The firm says CrowdStrike's third quarter proved why they are such a beloved company, reliably delivering a nearly 2% revenue beat over the guidance. Goldman Sachs has raised their price target on Marvell to $90 US from $80 and keeping a neutral rating. In an investor note, the analyst cited the strong visibility into its 2026 data center map and a 2027 guide calling for a 40% data center growth and a doubling of custom compute revenue. And Wells Fargo raised the firm's price target on Ralph Lauren to $385 US from $345 and keeps an overweight on the shares. Consistency of growth and execution are important for investors as credibility in the brand's elevation journey grows. Algoma Steel has made the difficult decision to lay off almost half of its workforce amid tariff struggles. CTV's Heather Wright has more on how the community is reacting.
Algoma Steel is in Canada's railways and bridges. It was used for artillery shells during the First World War. The company has faced challenges throughout its history, though perhaps none quite like this.
Yesterday morning, a list came out with about 900 names on it, and my name was on it.
Ryan Versanti has worked here for 12 years and will be out of a job in March. The company and many workers placing the blame for these cuts squarely on Donald Trump's 50% tariffs on Canadian steel.
The U.S. is our #1 customer, and we can't sell steel to them, so it's going to affect who we sell steel to, and we've been losing money, a lot of money every month.
In an effort to stop the bleeding, Algoma is accelerating its plant retool. The plan was already in the works and would have resulted in job losses, but wasn't slated to begin until late 2026 or early 2027. Today, the company's CEO said Ottawa was aware of this plan when it loaned Algoma more than $500 million earlier this year.
Well, I think the government certainly knows our business strategy. It knows the pivot that we had to make. It knew very well that the extreme pressure the company was under.
Michael Garcia says without that loan, the company might not have survived. And with tough days still ahead at the company, it will mean tough times for the city of Sault Ste. Marie as well.
It's going to mean probably reduced spending over the next short little while. And it's going to mean that supports are going to be asked of everybody to help families and the community members that need it most right now.
Among the projects Sault Ste. Marie's mayor is urging Ottawa to support is building a deep sea port here, which would allow for year-round shipping and easier access to international markets.
That was CTV's Heather Wright. When we come back, Patrick will take your questions on First Call. First Call, this time first email, and it's from Ian. Your thoughts on TELUS for a good dividend?
Yeah.
Timing of that.
So, well, they I guess they just paused their dividend increases. That doesn't mean there's any issue with their dividend at all as it stands. In fact, they reiterated their long-term free cash flow objectives, which is a good thing here. Full disclosure, we were short TELUS. We're short TELUS Bell and Rogers. We remain short Rogers, but not. We covered on Bell and TELUS in the new year. Yeah, we think that we're not sure what the catalyst is to get the stocks going, but I would consider the dividend safe here, and they do give a nice dividend. So. If you have patience and you don't mind kind of waiting around, I would wait. I mean, we could see what we're probably seeing right now is any stock that is down for the year, there's a tax loss selling aspect going on right now. Yeah. So don't pay attention over the next 3 weeks. It doesn't. There'll be a January effect. They'll go back up. So the near term is no indication of the long term, but I think you're fine. And this is coming from a person who was quite negative, when the stock was like $26 a year ago.
Okay. So we got a few more emails we want to get to. This one's from Shane. Do you think that it's a good time to get into Celestica? Oh,
I'd be very cautious on Celestica. There's a boom and bust, and this is all about their semi equipment side. They're getting great mandates. They seem to, I'm a former investor in Celestica when it was $5, but I've left that stock long ago, and there's a lot going on with it. It's very exciting, but the price of the stock is quite expensive to their earnings. There's a lot of expectations of future growth built out into it, and OpenAI, which is probably going to be a big purchaser of their equipment, and they may have some funding issues. Oracle, which has to build data centers, also may have some funding issues. There's only so much capital, smart capital, that's going to go into this stuff, and that could be a knock-on effect that short circuits some of this growth that has been built up. So I'd be cautious on Celestica. It wouldn't be my stock. Okay. Let's get one more email hopefully in from Melissa. And what's your outlook for BEP, UN, TSX, Brookfield Renewable Partners? But Brookfield Renewable, yeah. So I'm not very positive on the renewable space. I think the sentiment, the political sentiment has shifted away from that. And you can see Carney, just how he's backtracked on his green initiatives. It's nowhere to be found in Trump land. And I think the reality is that that we're going to have to augment our green with nuclear. It's going to take a long time to do, and in term, we're going to have to use carbon to do it. So it's these business models are built on a form of government push and government subsidization. And when you see that pendulum go back the other way, they're just really not a good spot to be in. So that's what we would say with renewables.
Okay, we're going to. This one's not. Well, you eat these Maple Leaf Foods. This is from an email from Billy. What do you think of Maple Leaf Foods?
We don't really like the business model. It's very for staple that should be very consistent. They're kind of all over the map. They've separated themselves from the hog processors, that now it's more about the consumer grocer. But having said that, we don't like the business model.
Okay.
And if anything, I would probably look to short it. I don't like staples here in general.
Yep.
I don't think they're going to thrive in an inflationary economy. So
all right.
That would be my issue.
Got to wrap it up there. Thank you, Patrick, for joining us. That's it for us here on the street. Patrick Horn is portfolio manager at Agilith Capital. And he's up next with the Open. The market's open in 30 minutes. Have a great day.